Hey guys, this is Rudy for Investor Investor coming at you once again from Palm Beach in Florida. As you can see, if you had watched my previous video, I was sitting in my office downtown, and now I am back in my home studio chatting with you from here. It's a tough day. I appreciate the fact that when I joke and say one Maserati, two Maseratis, etc. It doesn't impact everyone in the same manner. We are all emotional beings, and today was a tough day. If you're an energy investor like I am, then days like today are not the days that you aspire to, and days that you enjoy. And if you're long, as I am in many positions, and just to recap in case you haven't been paying attention, I am long some major energy corporations, including super majors like Total, headquartered in Paris. And then I'm also long in Enbridge, Bina, Energy Transfer, and of course, Occidental Petroleum. In addition to that, I am long a whole basket of uranium stocks. And as a result, in this particular instance, if I say one Maserati, two Maserati, or whatever, I'm referring predominantly to me, yours truly. But as you can see, I'm still smiling. The world hasn't ended. We're not subject to the sky falling and wearing blue caps. So what I thought to do is take a little bit of time and talk a little bit about what happened with Occidental today. In the first place, the good news story was early this morning when Occidental announced the most recent results of their debt tender offer. We're going to talk a little bit about that. And then what I want to do is just talk sort of more broadly about some of the things that are going on in the marketplace, some of the events that are happening, how many people, including me, from time to time, get things horribly wrong. So if you are concerned that you had decided to go long on Oxy and now suddenly you're sitting on a negative 15% from its high or something, that's a timing issue. But where's the market going? So we can talk a little bit about that. And then what I'm going to do is at the end of this video, I'm actually going to share with you what Occidental shared with me late this afternoon. So some news directly from Occidental Petroleum's Investor Relations Department. So let's get into this discussion here. I'm going to kind of fly through as quickly as I can because most of the stuff's not going to be of much news to you in terms of what happened today, because you probably already know. In the first place, we saw Oxy close the day down negative almost 7.5%. It's $2.25. Right here at the bottom, you can see it's down almost 17% from its most recent high, which was $33.50 just a couple of months ago. It seems like a lifetime ago. And extraordinarily heavy day in terms of volume. Almost 20 million shares traded today. And the average 10-day volume is only 15.6 million. So a very, very busy day on the market for Occidental. Now, to be fair, that's true of energy stocks, not just Occidental. It's just that the ones that are sort of higher risk, like Occidental, bear the brunt of this type of volatility. So when the market goes down, Oxy crashes. Of course, the opposite is also true from time to time, and we've seen it before. When the energy market spikes, Occidental in one day could go up, 10, 15%. Let's see what happens tomorrow if you're long. If you're not long and you're day trading or something like that, it's a different discussion, right? Unusual options activity today. I first want to share with you a little note here from Hans Intact. Hans shared this with me in the comments section, shared with all of us in our community channel. He said, just buy puts when Oxy is up. That way, when it comes back down, you can act as if Oxy is up with a smiley face. Many people have different trading methodologies. I don't day trade. I typically look for an undervalued company, buy it, hold it long and strong, and wait patiently for my return on investment. It's worked well for me in the past. I'm not saying I'm right. On a day like today, sometimes I feel very, very wrong, but to each his own. But I thought this was kind of a cool little clip by Hans to share with the people on our channel. There's sentiment today. There was some unusual options activity. It's a bearish sentiment. It was a sweep option. It's puts. Extraordinarily large volumes compared to historical averages is usually an indication of unusual options market activity. Volume refers to the number of contracts traded over a given time period. when discussing options market activity. Let's just dive down one level deeper and talk a little bit about how this works and what it means. The trading of a contract with an expiration date in the distant future is a sign of unusual activity. And by the way, the derivative that you might own, which is the OXY warrants, also has an expiration date, which is in the distant future now, just over 6 years from the date of issue, which was last year in, was it July? Well, it's been a year already. Anyway, that's a derivative that also has, that's like a call with a very, very long expiration date. Out of the money contracts are unusual because they are purchased with a strike price far from the underlying asset price. Puts are out of the money when the underlying price is above the strike price. So that kind of gives you a little bit of a variation there in terms of the theme, whether you're buying puts or calls, coming back to Hans's comment saying you should just buy puts. Options are bearish when a put is bought at or near the strike price. But we actually don't know why the investor, actually I like the comment here, it's like why the better, because it's kind of like gambling, right? We cannot be sure why the investor or the better is playing the contract. Is he playing the contract outright? Is he hedging a large underlying position in the common stock or whatever? Those are things we don't know. So generally with an options contract, you can see them because they're visible and we can kind of see what happened, but you don't really know what the underlying reason is for whatever it prompted that particular trade. Today, most sectors finished in the red. If you look at the actual spread of the sectors here, very, very interesting. I mean, the top three guys just barely made it into positive territories. And I suppose if you're into utilities or real estate, you'd say almost 0.5% positive ain't bad. But look at the rest. And then, of course, we have energy right here at the bottom at negative 2.12%. In the previous video, I talked about the agreement between Saudi Arabia and the United Arab Emirates. I'm not going to go there. The rest of the news is just like, it's news. It's like news any other day. Nothing really much material happening in that regard. I said we're going to talk a little bit about experts, and I picked one particular expert, and I didn't pick Cathie Wood because I dislike her or anything like that. I just picked one because I felt I'm only going to pick one for time purposes, so I don't keep you too long. But this was last year. So in July 15th, which is now almost exactly a year ago, Cathie Wood said that she believes the oil price had peaked at more than $135 per barrel in 2008 and has been hitting lower highs and lower lows as demand growth has disappointed expectations for the last 12 years. That is mostly correct. But then she went on to say, and by the way, this is from her Twitter account, she said oil demand probably hit a secular peak last year. Now, this was 2020, so she says in 2019. And now, thanks to electric vehicles, is in a secular decline. Well, that is absolutely not true because the electric vehicles cannot possibly, at this stage of the game, cause a sector decline for oil in terms of the consumption and demand, because there are so many industries, agriculture, shipping, air transportation, whatever. In addition to the fact that EVs only make up about 2% of the total car manufacturing market, that is just not correct. ARC has no formal forecast, but believes that the oil prices are on their way back to $12. Now, of course, she says $12 here, and that means $12 per barrel, the level reached after the 1973 oil cartel crisis or lower. That is the type of comment from an institutional investor that usually indicates to you that they are short, and usually also indicates that they might want to hedge that particular position. I'm not sure about ARC's portfolio. I know about some of the high-profile stuff that they're invested in, like Tesla and Zoom and all that. But I don't follow ARC. And as I said, I'm not picking on Cathie Wood. She's lovely. And I think last year, her ARC ETF fund outperformed the S&P significantly. I think the S&P was up like 43%, but ARC was up like 150 or 155%. Just a month ago, May 11th, ARC's Cathie Wood predicts a serious correction in commodities. That may be absolutely correct because it may still be coming. We don't know, right? Nobody knows what's going to happen in the future. The same way nobody knew last year that we were going to have a coronavirus pandemic that was going to impact everything we see, do, taste, feel, etc. ARC says Kathy Wood weighs in on oil, says a $70 ceiling. That was on May the 11th. So just 2 months ago, she said oil's going to hit a peak or a ceiling of $70. Well, we blew past that one quite easily. So my point here is not, as I said, to diss Kathy Wood. I really like her. My point is to say, whichever expert you prefer to listen to, always counterbalance that with someone else that maybe gives you an objective counter opinion, or just counterbalance whatever you think is happening and make sure that you stay informed. Now let's talk a little bit about Occidental's debt tender offering. So Occidental announced early tender results and an upsize in the cash tender offer. That was at 8 a.m. this morning, today, which is July the 14th. It is Wednesday. So this was good news. Sorry, that was yesterday. I don't even know what date it is anymore. But anyway, in connection there with Occidental further announced that it is increasing the maximum aggregate purchase price of the notes it will accept for purchase. And it said that the maximum aggregate purchase price from the previously announced amount of $2.5 billion will be increased to $3.1 billion. This is very, very good news for Occidental. So now, by now, if you have been following this channel, you will know that when I see news like this, I do what I typically do, and that is I go straight to Occidental. And in this particular instance, I said, give me some daylight and give me your eloquent opinion and expert opinion on the interpretation of this debt tender offer, rather than having me talk about it, because, I mean, everybody, including Kathy Wood, is much, much smarter than Mr. Oxy. So I contacted Occidental, and this is their reply. I quote, today, in other words, I received it today, Wednesday, was a rough day in the market for the sector and Oxy, with oil being down sharply. We are very pleased to have been in a position to upsize the tender. This is the fourth tender we have completed in just over a year, and the first one that was not part of a larger refinancing effort. That's good news too, guys. It's the fourth one, and the first one that was not part of a refinancing effort. In other words, refinancing is what you do when you cannot pay your debt. In this particular instance, they did not have that problem, or the interest on your debt. The first three tenders were aimed at de-risking our balance sheet. I'm sure by now you all know that, by refinancing near-term debt maturities, while the most recent tender, in other words, the one that was announced yesterday, is part of our ongoing effort to reduce debt as part of our near-term cash flow priorities. So, guys, regardless of how you slice or dice this, I did share in the previous video that in general, overall, from a macro thesis point of view, it's a good news story. We have WTI in the 70s. That's good news, right? We know Occidental's break-even is around $35 per barrel. That's what they told us in the previous conference call. It doesn't matter what experts say, and for heaven's sake, if you want to share expert opinion with me, please share experts like Kathy Wood, rather than sharing experts like Jim Cramer in terms of whatever it is that you're following, or whatever TV channels it is that you watch. But we have WTI at a high price. The impact of the agreement, the OPEC agreement between Saudi Arabia and the United Arab Emirates, adds only, and I say only, not only as figurative speech, but in reality, it adds only 450, I think 480,000 barrels of oil per day to the supply of the OPEC plus group. 480,000 barrels is less than what Oxy produces by themselves in one day. So this is not material. What it is for us is an indication that OPEC is still trying to restrict supply in order to keep the price high. And why should they not do that? I would do that too. There are macro themes that play into what we do as investors. For instance, from a US point of view, one of the most troublesome and concerning macro thesis or environments that we need to pay attention to is the current administration. They are, for political reasons rather than for fiscal or monetary reasons, or in terms of good stewardship of the economy, but for political reasons, they are going with this populist opinion of trying to cancel pipelines and cancel fossil fuels and things like that. They're doing more harm than good. And most of the time, I think they don't really understand what it is that they're doing, because the world is still consuming around 100 million barrels of oil per day. So if you want to impact that demand and impact it in a significant way, you don't do little nitty-gritty things that irritate people, like canceling the Keystone XL, which was just an extension to the existing pipeline. In other words, it's business as usual. You just said, Trump approved it, so I'll cancel it. These are games that they play. Other than that, there's macro risk related to things like invisible threats, climate change, CO2 emissions, coronavirus pandemics, things like that. Most of the things that scare us the most are actually invisible, like the things I just mentioned. What we have to do is basically say to ourselves, what do I want to invest in, for how long, and what's the expected return? And when you achieve it, cash out. There's no harm done taking some cash off the table, or just take some cash off the table and let the rest just run and do whatever it does. So what I want to share with you, though, overall, is that I don't really see too much bad news at all. Probably the biggest risk right now is the inflationary risk of the central banks, not just in the United States, but globally, just printing money as if it's going out of fashion. That inflationary risk is probably the worst macro risk for me right now at this moment in time. But other than that, it's all a good news story. So let's see what happens tomorrow. Maybe Oxy pulls back a little bit more and gives us a buying opportunity potentially. Maybe it bounces right back because of all the good news that I just shared with you a minute ago. So on that happy note, this is Mr. Oxy signing off. Thanks for watching. Let me know in the comments what you think. Bye-bye.